there's always something for us to be grateful for, especially when we understand that there's multiple components to life, and that one of the ideas that we believe here at Factum is the perfect life or an ideal life is having abundance in all of these areas, with the spiritual one being the most important. Your personal life, family, financial, occupation, and tonight we're going to be talking about how to win financially, specifically around the concept of infinite banking, and addressing one of the biggest questions I think we get, David, is why we created this Infinite Banking Mastery Workbook, because people read Nelson's book, Becoming Your Own Banker, they tie into some of our events, and I get this question all the time, like, why would I do infinite banking?
Yeah.
Why would I want to become my own banker? And a lot of times it's hard to quantify what that's worth to a family, but we were able to do it with this new workbook that we launched in November. So if you were at our last mastermind, you got the first look at this, and that took us 8 hours to go through this and actually do the deep work that's vital to implementing infinite banking at the highest level. And so we're going to be going through an 8-hour exercise in just a high-level overview over the next 60 minutes. So we're going to have everyone out of here by 6 p.m. Or 7 p.m. Arizona time. So let's jump right in, David. This book right here, Becoming Your Own Banker. If you have not read it recently, we encourage all of our clients to go back and reread this at least once a year.
Yeah.
Because as you're progressing through what we call the 4 stages of ownership of whole life insurance, you're going to change, grow, and develop in the money game. And you're going to come back and read this book, and it's going to hit you totally different than the first time you read it. Any good read is like this, by the way. And so let's start with just one of the main premises in part 1 of the book. This is page 11. And, you know, this is something we've been teaching a lot lately, that the world of banking is something that affects every single one of us as employees, self-employed individuals, business owners, and investors. It's worth a little bit of everyone's time on the call today to go spend a few hours and study the world of banking and how it affects you, no matter what player in the money game you are. So this is straight from Nelson Nash. He says, perhaps some of the answer lies in the fact that most folks know nothing about the process of banking and its importance in their lives. Banking is the most important business in the world. Without it, all businesses come to a screeching halt. Whenever a business transaction takes place, money must flow from one party to another in a relatively short amount of time. Otherwise, nothing takes place. And that flow of money must come from a supply source or a reservoir. And that is the essence of what the banking business is all about. Someone or some organization has control of a pool of money that can and must flow at a cost to meet some need. And we're going to be talking about this idea of the world reservoir as money and how much of that do you currently own in your life. So let's jump right into this, David. We're going to be looking at a top 5% American family that's been through some of our tough money curriculum, which is the money management disciplines you'll need to in order to be successful with this concept. So David, why don't you run us through this segment right here?
Yeah, and we call it a top 5% American family based on income. So $300,000 in income gross as a household puts you at that top 5%, or you make more than 95% of the rest of the country. By the way, the problems we're going to discuss here are ever present. They're present for families that make more money, and the problem gets more significant because there's more flow of money through your hands. And it is also creating a lot of financial pressure for people that have less income because they have to be more efficient to keep more of what they earn, Kyle. But if you look at here at these 3 different sheets that are part of our Tough Money curriculum, we're going to describe the problem in simple terms. A family that's earning $300,000 in income or more, but only keeps 5% of that income or saves $15,000 a year, it's doing what the average American does. They don't keep enough of what they earn. And this starts the cycle of financial pressure that we're going to describe moving forward. After that, they're going to make decisions about where to keep that 5%. And typically, they're not thinking in terms of maximizing the benefits of that money. So they will hide some money under a mattress. They'll keep a lot of it at a bank that is not really valuing their relationship. They may buy some precious metals, but they're not dealing with an intentional strategy to maximize those benefits. And because they have poor savings environments, at the end of the day, they're not going to have enough liquidity. They're going to have very little liquidity, and they're not going to have the right amount of protection they need when future events come, or more importantly, in most cases, when opportunity shows up, they're not in a position to take it and take advantage of it. So this describes the recipe for what we call weak money. Very incredible incomes, but low savings rate, not very efficient savings environments, and not a lot of liquidity.
And these are I think the biggest points of financial pressure for most Americans, David. Yeah. If you ask them, where do you stay up at night? What's on your mind? It's something around we don't have enough liquidity. We're not saving enough. All of these are stemmed from financial behaviors. And so it's why we built that Tough Money workbook. So,
and before you move to this one, let me just throw one more comment in there. We move really quickly through those sheets and those numbers. And the point of this conversation is not to get into those numbers tonight. But if you for sure do not know what those numbers look like for you with respect to those three categories and those three conversations, our advice to you is to please, I highly encourage you, have a conversation with the person that invited you to this call, because they have incredible tools for you to know for sure what your savings rate look like, what's your environment, the maximization of your benefits through your environments, your liquidity strategy, your days of liquidity. If you want to know for sure and have confidence about where you are and where you want to take this, we have the tools to help you answer you.
There we go. So let's talk about these 4 stages of whole life ownership. Almost everyone that gets into this process starts in what we call the saver category. You're just looking for a more efficient place to store your wealth. You literally cannot start the process of becoming your own banker unless you have some type of saving element already in place. You cannot start this process with just OPM, other people's money. You've got to start it with your own. That's the strongest, toughest way to do this. Next is they'll shift from being like a saver, David, to like now they're using life insurance as a wealth building tool. I still would not call that infinite banking.
Nope.
There's a progression and a significant jump to go to stage 2, the wealth builder, to stage 3, the business banker. And that's also the biggest impact on how much of that reservoir you're going to control in your life.
Yep.
And then once you got that down, it's fairly simple to just carry that momentum into the stage 4, which we'd call now you're actually doing infinite banking. Now you're classified as what we call an infinite banker. And you're working on more advanced, complex things like family banking, influence and significance, wealth preservation. You have a wealth team at that point. And so I think where I see people go wrong with this, David, is they jump into owning whole life and they immediately start to jump to like stage 4 strategies and mindsets when they don't have the right tools and disciplines to even go to a stage 2, stage 3. Okay. And this is where I think you can feel frustration, almost like you're just spinning your wheels. And you're like, why am I not getting ahead? Well, you're focused on a strategy that might be, 2 steps above where you're at. And because you're not giving the things that you should be focusing on the attention, you don't actually make any progress. Yes. And that's when you feel like you stall, you burn out. And so our hope for today is we're going to set the precedence with this high level conversation around really be intentional with these. Where are you currently? And we're going to walk through each one of these. And how do you get to the next stage? We're going to show you the exact roadmap to make that happen. And so let's do one more visual though, because owning whole life insurance, moving through those stages, it has nothing to do with investing or investments. This is a control conversation, and we're talking about permanent control. Yeah. So what you're seeing in green in each one of these stages, that's your money reservoir. Everything else in red flows past your life and ends up in the world reservoir to debt interest, taxation, just poor money management habits. Yeah. And so you can see the net effect of like, why would we say go to the infinite banking level? Because you're going to control and harness more dollars that are already flowing through your life. And we're not even talking investments yet. Yeah. This is just money will flow, and it has to in your life. How much of that function do you want to own and control? When I first got exposed to this was so compelling to me because it was like, yeah, I'm going to do this anyway. So is every other American. Why would I not implement this and bring this to my family immediately, which is what I did. I was like, we're going to be doing this stuff anyways. We might as well profit from this and control more of this money as a family.
Yeah. And what we're doing here is taking it a step forward, by the way. This is the same family making $300,000, and they're just going to use this as a tool to know, where am I? In what stage of the process am I? And the second and more important question is this: what is it costing me to stay here and do nothing or not progress? Because that is what is going to tell you, maybe it's okay. Maybe I just want to be in stage 2 and it's okay. I'm not. But if you don't understand the opportunity cost or the cost of not progressing, it doesn't create the right perspective for you to make this decision with confidence. We're going to give you the tools for you to use your income, your numbers, your liquidity, and decide how much money out of what's flowing through my hands am I controlling, and what is it costing me not to progress to control further and further more of that reservoir of money that I can create privately.
I love it. So let's get right into this. Stage 1, the saver. Now, David, you were real intentional when we were putting this workbook together to add certain images. So the way I would think about this if I'm on the call tonight, when you're in a stage one, you're kind of in this mindset of like, okay, I think this is something I want to do. I'm going to get a little policy and I'm going to test this out. I'm just going to dip my feet in the water, right? That's kind of what you're doing with whole life. I like the concept. It makes sense, but I'm still a little bit hesitant. We were all there at one time. And so the stage one is, imagine the ocean is the world reservoir and you've got a creek or a small river like this flowing behind your cabin, and that's the water that you currently own. Of the entire flow, the entire vast water in all the ocean, everything, it all ends up in one place. Money is no different. The equivalent of what people are doing in a stage one is they're starting to get more intentional, but you still own a very, very small of the world reservoir, when it doesn't have to be that way, but it is because of the way we think, right? So the mentality of a saver is just this. You're getting some financial education, you're building financial awareness around your money strategies, and you're becoming a tougher saver. So all of us need to save more money. It's an American problem. Wealthiest country in the world, one of the lowest savings rates.
Yep.
You know, and we hear it all the time, David. If I could just increase my income, that would solve all my problems. I always think that's smart to go out and be better at what you're doing and drive more income, because we live in the land of opportunity. The problem is not in our income, it's how much of the income are we actually keeping.
Yeah.
And at this stage, when people figure out, oh my gosh, I should just save in a more efficient place, which is whole life insurance, they're really doing it because, number one, they do need life insurance protection.
Yep.
They do need some type of emergency fund, even if it's a couple $1,000. They need an alternate place to store wealth, because where they're currently saving, probably Chase Bank, if you're getting 0.01% and the only other benefit you get when you walk in is it's liquid and they might give you a sucker when you leave, you know, there are other institutions out there that'll give you so many more benefits just to change where you save money. And that's kind of what was going on in my head when I was looking at whole life, just saying this is a great place to save money, but I really wasn't using it yet.
Yeah, absolutely. So let's take a look at how we think about sizing this properly, right? So again, let's go back now more into the detail and the math of this. And we're about to go and work through some numbers. For all of you on the call that are more visual learners, we're going to put this into a couple of charts for you to see it in both perspectives, so we can capture this concept in what it means to all of us. But this family, top 5% American family, $300,000 in income, I think is what we're going to see here in the chart in a second. They have a series of expenses, including taxes, and they're keeping 5% or $15,000. That's the basic premise we presented at the beginning. If you go forward here in this person's stage, they need to start making some decisions about where to store those $15,000, Kyle, because not every environment is created equal. Not all the benefits are created equal. Not all the circumstances are created equal. And that changes the potential for those savings. This is the difference between people like me, like Kyle, like many of you in the call that get excited about savings because we understand what it's doing over time for our life, versus the people that are not incentivized to save and they never get above that 5%. So the math here, we're not going to go through your personal math, but we want to give you a framework to think of. So if we take that income, okay, and we're going to take a period of time, 30 years, so we can make it long term and we can see the spectrum here or the impact over your life. And then let's say that they had $80,000 already saved, money that they have in reserve. We're going to include that capital to be fair, to make it more realistic, and they're going to compound this money annually at different interest rates. I think the two examples we're going to illustrate for you are the following. They're either going to keep money at a bank, let's say the four amigos, Chase, Wells Fargo, Citi, right? They're not incentivized to give you any yield on your money, but they keep it safe and liquid. And we're going to compare it to a better environment like whole life insurance, which is a 4%, 3 to 4% net. We're going to use 4%. And we're just going to run some simple future value calculations for you to see the drastic difference that these decisions make. So the first line item, Kyle. This person, typical American behavior, save 5%, which means that they're going to save per month $1,250. Okay, 5% of that $300,000 or $15,000, and they're going to keep it at a bank earning nothing for 30 years. That sounds like an unrealistic thing to do. Think yourself, how many years have you left money at a bank when interest rates were zero, sitting there doing nothing for you? This is not as unrealistic as you may think it is. It's happening for most Americans. Chase has $2.4 trillion of deposits. Wells Fargo, another $2 trillion. Citibank, this is trillions with a T of Americans that are numb with their relationship with money. So if you do that for 30 years, those savings will be equal to $500,000, $530,000. That's our baseline. I know I'm throwing a lot of numbers at you. This is going to make more sense in a chart in a second. We are going to replicate the same exercise, Kyle, just by changing two things. What if we change the environment and we move out of the banking to whole life, which most of us in this call are very aligned with? And what if we start to prime that pump with more and more savings to see the actual effect? Is saving exciting? If you start to show the answers here, just by changing the environment, same savings, same initial capital, Kyle, just by moving the money from bank to whole life, the result is $1.1 million or almost double.
And how much risk and how much noise are we taking by doing that? Whole life is literally the safest place you can save because of the guarantees, and you're going to find a much higher competitive yield than most commercial banks are willing to pay you.
How much effort?
Just by changing the environment, we've created a significant or controlled a significant amount of that flow of money in our life. And where I think a lot of people get this wrong, David, is they overlook these simple steps early on. And they say, well, I want to skip all that boring saving stuff and I want to go right to investing. If you go out of sequence with this, that's when you start feeling like, yeah, I'm investing, I'm chasing returns, but I consistently lose because you don't have the right foundation set up and you might not have the right investing criteria. And you start doing steps that you see other people doing, but they're at a different level. Yeah. And they can do these things probably more efficiently than we can because they have different habits, different things were already in place. And so this is something that's so relevant to the brand new person on the call that's just entering the money game, all the way to the multimillionaire that we get to work with that needs stronger financial disciplines here as well. But everyone that we've come across in the last several years, thousands of individuals, even the highest rooms that we get to teach in, David, we rarely see people with a thoughtful framework on how to be more efficient with where they hold cash reserves.
Absolutely.
We see it on the investing side all the time. And what's great about this is every single person on the call can control these things in your life. In fact, the inconvenient truth is you're the only one who can control these things in your life. So if we go to the stage 2 wealth builder, David, all we're really doing is saying, I'm getting more intentional with my money. I'm going to increase my savings rate to 10%. I already know where to save that. Now, instead of saving $1,200 a month, they're saving $2,500 a month. Well, look at the compound effect that has on the money that they're controlling in their life over the next 30 years. When you go to the business banker and the business banker takes a significant amount of intention, it's going to be more work, but you're ready for the work because you already have some of the basic disciplines. The jump to go from 10 to 30, look at that difference, 1.9 to 5.3 million. Mm-hmm. And why would someone want to go to the infinite banking level where you're probably trying to get 50% of your income into this asset? And you might be incorporating things like taxes, travel, insurances, vehicles, things like that you can convert all to your side of the equation. $8.5 million. And so we get the question all the time, like, why would I do infinite banking? What's the cost for my family? It depends on a few variables, like how much are you earning? What are your savings habits? But if we were to ballpark it for this top 5% American family, to not implement what we're talking about tonight is an $8.1 million lost interest cost for this family. Not because they're missing out on investments, because they're not understanding banking and how to control more of these dollars permanently in their life.
Yeah. If we go to the next slide, let's put a visual to this because I think it's going to help many folks that think about it in a different way. Look at the colorful chart we have here on the screen. We are describing the same family, and again, we understand we're simplifying this, but this is an important realization. We are reducing this to same family, same income, with very different potential in their savings because of two decisions they control and that represent no risk or noise in their life. The ability to decide where do I want to store my money to maximize the benefits of my money and at what rate I want to save the savings to compound. These are things we all control by just becoming more efficient, by reducing low value spending, getting a better tax professional, financing things in a more efficient way. All these things are a progression and a journey to say the following. All of us in this call have the ability to choose and decide that we want to strive to be more efficient and have more potential in our savings, Kyle.
Love it. So what's the stage one saver doing? Saving 5% of their income, starting to get more efficient with where they save money. So typically what Americans are doing, they're leaving most of their cash or cash reserves in environments that are remarkably inefficient. And the benefits that most of us are getting, depending on where we're saving, is liquidity, like it's got to be accessible. It's safe, so it's got to be non-correlated, right? So if the stock market crashes or something, you don't see 40% of your cash in your safe disappear, and you don't see 20% in your checking account just disappear because the market went down, or insert whatever scenario there. So in order to qualify for a savings environment, the money's got to be liquid and it's got to be safe. The next benefit that most people are looking for is some type of yield.
Yeah.
Now, there was a 10-year stretch when I first started buying life insurance, like over 11 years ago. We're going to look at one of those policies in just a second. I couldn't find yield anywhere as a 25-year-old. There was nowhere for me to save that even offered me 1% growth. And that's gross, okay? That's not even net 1%, it's gross. So that's before taxes. And the reason we love life insurance is because you get these 8 benefits. More importantly, you get them in a guaranteed contract for your entire life. And this is why we would say whole life insurance is the toughest asset you can own at your foundation, because you will not find, and we have not found it, any other singular asset with these 8 benefits built into one place. And the reason we'd never call it an investment is because this is a liquid, safe, guaranteed environment. So it has the same benefits that constitute a savings environment. We would never call this investment, which is the biggest misconception people have when looking at this. Yeah. They say it's got a low rate of return. Well, if you're comparing it to investment, you might say that. If you compare it to what it is, a liquid safe asset, I do not think this thing can be beat.
And it comes down to the quality of the questions you're asking. We just talked about, hey, same family, same income. Look at the opportunity to just save more in the right environments, how that compounding happens over time. You've been saying this a lot, and it's been stuck in my head. Compounding doesn't reward the early investor or the early saver. It rewards the consistent one. The dramatic changes happens at the end, at the tail of these curves. Whatever you are on the stage, whatever your stage of life, age, the consistency is what we're driving here. And the question that I want to bring on top of this that we're not going to answer, but it is what you said earlier, is what is the cost of not having the liquidity creation and the opportunity of accumulate all that capital in your private reservoir to then go and invest and create more opportunity? That's the part, the invisible parts of this conversation we never get to talk about, which is why we need to start with the basics and maximizing the potential of our savings.
I love it. And let's go back in time a little bit, David, because I'm thinking about when I bought my first policy, a lot of these benefits did not jump out to me as a 25-year-old.
For sure.
What was I looking at? This thing has a cool loan provision that I could use to pay off debt, buy vehicles, make investments. That's awesome. It's very unstructured. It's, the yield, the growth on policies, when I was watching, I'm like, this is an amazing asset. I should have bought this 5 years ago. I didn't know about it back then. But now that I'm a little bit older, our wealth situation's different. You know what I really value now more than ever? The death benefit, the protection that I have now for my family and my kids, the private nature of this asset. The fact that my cash is constantly compounding every year. So when everyone else is panicking, trying to find investment returns, I can just be so patient and wait for the best opportunities. These benefits will jump out at you at different time points in your journey, especially as you're growing. And so that's what's so compelling about this. It's really one of the most exciting assets I've owned. Because all of those benefits are constantly working, but they'll probably hit you at different time points in your life where you're like, what I really love is the privacy part of this thing, where I didn't really care about that as a 25-year-old.
Absolutely.
All right, so let's move into stage 2. When do you jump up to the stage 2? Now, there's a big difference, David, I think, between people who have life insurance and those of us who are using life insurance as a wealth building tool. Yep. So when my wife and I started our first policy over 11 years ago, the first thing we did is we took a policy loan, we paid off her debt. I should say our debt, right? It was our debt. We were married at that time. So she had a car with a car payment, and it was like a 7% interest rate on it or something. Now, I didn't really have an investing criteria back then, so paying off debt at 7% was the best investment option I had, because that's a guaranteed 7% return. And we took that same payment we were making to True West Credit Union, and we just directed it back to our banking system, okay? And so that was the first time we used our policy. And once that clicked for us, because when you're using it, that's when you really get good with it, right? You understand the policy loan mechanics, things like that. And so we ended up buying our second policy 11 months after the first one, because when those things click, you go, we need more of this. We need to expand this. I need more control. So the visual we have on here is the same type of visual, but you're controlling a different flow of money, a different part of the reservoir. And we want to control as much of this as possible by the time we are truly doing infinite banking. So let's jump into this. In the stage 2 wealth builder, this is when you're going to start redirecting cash flow. You're probably using this policy as part of your debt strategy, your investing strategy, and you're trying to find this ideal balance sheet ratio between, am I ready to invest? And is my foundation tough enough to allow me to do that with a high level of certainty? Any thoughts on that?
Yeah, I mean, and that is a function of the things we talked about in the previous stage. Have I saved enough? Do I have enough liquidity? Am I maximizing the benefits of that liquidity? Once you're confident that you can answer that with clarity and your days of liquidity are sufficient to have no financial pressure, we're in a position to start looking at other parts of the map and say, hey, why would I pay 29% on a credit card when I can take these funds from the flexible loan provision and start capturing that same spread? Why would I go finance the next rental property with a loan from a bank where I can access capital with different terms on a private basis? That increases our optionality and increases our ability to, again, use, not just own life insurance, which is what I said. By the way, if you want a clear definition of this, think about where your life insurance policy is or your proximity to it. If it's in the drawer on the kitchen, you are waiting for somebody to get sick or die to read it for the first time, that is a very different conversation than how do we make this a meaningful asset for you to have a relationship with your money from a control and ownership position. Very different conversations.
Love it. So if we look at this top 5% American family, the jump from a stage 1 to stage 2 is still really good, just by changing some of your habits. Now, if you're kind of on the call and you're looking at this like I was years ago, I knew the best thing Diane and I could do at this stage was not run out and chase returns and invest. It was to actually invest dollars into seminars and networking events where I could get around the right people and the right education to make sure I increased my active income and I increased my proximity to other people who were winning. So that was going to be my best investment rate of return, is investing into myself and getting better, like increasing income and getting better with the current money I already had. Once we had those down, I was in a much stronger position now to go into the stage 3. So that's what I would say to everyone on the call. And so when you go to the stage 2, we're getting more intentional. So it probably looks like this. On the left side is their current strategy. They're saving 5% of their income. Now, when you go to the stage 2 wealth builder, you've got to increase and make savings the priority. So we're going to change the savings rate from 15 grand to 30. And the only way you do that is you have to go in and rebalance your expenses. Now, we do this not through budgeting, David, and I hate the word budgeting. We do this by eliminating low value spending. You see, all of you and us on the call, we all have dollars flowing into our life that's going to 2 Netflix accounts, an unnecessary amount of Starbucks runs, whatever that is. We all spend money different ways, but if you eliminate what's called low value spending, things that you don't really care about anyways, if you got those out of your life, you can increase your savings and you never feel an interruption in your lifestyle. Yeah. And that's different for everyone. Some people, they have to have the coffee. Some people, they have to have 2 gym memberships, whatever that is. You have high value spending and you have low value spending. And I think where people go wrong with this is they never spend enough time to get good at this part of the wealth game. So it doesn't really matter how much income you make. You will always be a 5% saver unless you fix that habit early on.
Yeah, I'll tell you one quick parenthesis comment here. Like the last 2 days, Kyle and I spent with a series of business owners, and it's fascinating to hear people that are, bringing 7-8 figure revenues into their business saying the game here is to manage expenses. And these are people that no problem can spend $20,000, $30,000, $40,000 on a vacation, and yet they're looking at a bank statement going, why did we spend $30 in this fee? And why did we pay for 2 memberships for this 45? They are so disciplined at managing expenses. By the way, keyword here, managing, so they can have the right ratios in their business, in their income, to produce the profit they want. And if you bring that to the you and me level, it is no different when we say, hey, the decision here is I want to keep $30,000 of everything I'm going to earn this year. And what is going to require honey, husband, partner is we need to go look at our expenses and get intentional about how we allocate the difference.
And you don't do that by eliminating all the fun stuff. You do it by eliminating low value spending.
Right.
Okay. So Compounding does not care when you start. The amount of times I have heard, am I too old for this concept?
Yeah.
I think the question there, David, behind the question is actually, I believe, it's my limiting belief that I am too old to be successful at this point.
Yeah.
That's really what I think the question that's being asked. And so obviously there are advantages to starting anything earlier in life, but that's life. And at a certain point we have to own it and say, is there enough time left with my time here for me to be successful? And that answer is always yes. Because the reality is compounding does not care when you start. Compounding only rewards those that don't stop. You see, we all started in a similar spot, but look at the separation that this has over time. You wouldn't believe some of the success stories that are in our community of people who have been at this, working it for 4 years, 6 years, 8 years, 15 years. I think most Americans could change their entire financial life, David, and win the money game, like retire early in a 5, 10, or 15-year time period, but they don't focus on the right things, and they don't stick with it long enough.
Yeah.
And I think that's the problem.
Yeah, yeah. You know, I was just thinking about this as we were preparing, and we can go to the next slide, but I'll tell you, one of the conversations I have recently on a weekly basis is the client that has not been close enough to the policy and said, whoa, you're telling me there's 40,000, 80,000, 200,000, and I did not know that. And it is because it is happening. You consistently put the habits in place, and this will reflect results that will surprise you, especially if you do it in an intentional way with your education. But let's talk about this illustration example.
So this is over 11 years ago. I was in a room with a orthodontist here in Chandler, Arizona. I was 25. My wife worked for this guy. And back then, I was searching for more education. I wanted to get in the right rooms because that's how I knew I was going to increase my income and get up to the next stage of wealth building, right? So good decision for 25-year-old Kyle to go into this room of millionaire dentists, surgeons, orthodontists. And there was this older orthodontist, 65 years old. And, you know, one of the things that I love is, I'll say, gray hair matters. I think we've lost the ability to look at older generations and learn from what they know. Experience is irreplaceable. So he's teaching all these younger professionals all the things that he wished he would have done differently. And so when he was teaching about this, I was like, I got to get one of these policies, right? So this is the first policy I bought after listening to that orthodontist. And keep in mind, back then, I had everyone, including family, telling me, don't buy life insurance. It's a terrible investment. It's got a low rate of return. It's super expensive. Literally, it's the worst thing you could ever buy. And I'm so glad I did not listen to them, because here's what's happening now over a decade later. So in year 13 of this policy, which is where I'm coming into in just a short amount of time, I'm going to pay in the same $8,000 or so that I've been paying into this policy. It's going to grow $13,000 that year, or it grows $1.63 for every dollar I put into this thing.
Yeah.
Now, the unfortunate part about this policy, David, is that it can only hold about $8,000. Because now I'm like, I wish I could put 80 grand in this thing.
Yeah.
Heck, I wish it had the capacity to go 800,000. You know, if you add an extra zero on this, that number becomes not 13,000, but 130,000. You go one more zero, it becomes $1.3 million.
Yep.
It's that substantial. And big policies work the exact same way as small policies.
All of you on the call, if you own life insurance, at some point you're going to be mad with one of us because of the same realization. I wish my premium was bigger. We are saying in this call, we apologize in advance. It's the nature of the game. But it is what happens. I wish my premiums had a 0 or 2 in addition. Hindsight, and we start where we can. But that realization makes this a really valuable asset, Kyle. And that's just what's happening now. Like, roll it into the future.
Yep. The cool part about this too is the first 10 years are the worst years.
Yeah.
Because now if we go another 15 years, the advantage I have now playing the money game is so substantial. If we go 15 more years, I'm going to pay the same $8,000 a year in premium. Now it's going to grow by $24,000 that year. Keep in mind, non-correlated, not attached to the stock market. This is completely, like, 100% going to happen. That's $3.10 for every dollar I put into that thing. If we go another 15 years out to age 43, and this is exactly why that orthodontist literally told me one time, I was having lunch with him, he said, I'd give up all my wealth that I have today to go back in time and be your age and start from scratch had I known this stuff. Yeah. Because in year 43, if I drop this thing down to the minimum base premium, which is $2,600, that'll grow by $13.50 for every dollar I pump into that thing that year.
It's incredible. And I'll isolate a couple of things that you're not saying, Kyle, because I think there are important lessons here. Number one, please recognize we're talking about stage 1, stage 2. There's a progression. And the reason we're putting this lesson right here is because when we look into the future, we see a transition for most of our clients, including ourselves, where we see premiums as an expense. And at some point, we see the realization that premiums are actually what are funding their ability to create a private reservoir of money. And that premium is the solution, like Nelson says in his book. The second thing is, we use 15 years just because this is the way we set up the class, and the time frame, really, it's a long-term approach, and it doesn't really matter. But the point is this: if you start to think about this as a business in itself, which is going to be the transition to stage 3, what Kyle is describing is a business that keeps expenses or the premium or the capital contribution the same, with a profit that continues to increase with no risk, no noise, regardless of what happens in the economy, regardless of volatility of markets, inflation, taxation. It is a savings environment that is going to perform more and more and more efficiently every year. So when would you like your ability for you to contribute to this to stop, and how many zeros would you like to put to it?
Exactly. And are we investing yet, David?
No, we're talking about saving strategy. We're not talking about any risk or any investment. By the way, along that cash value, every year, do you have the opportunity to go and invest with it, Kyle?
That's where this thing gets fun.
Yeah.
Now imagine using this from the place you deploy money to go make your investments, whether it's real estate, in your business, stock market, whatever. Then the returns that you're getting now on your investments, where should you flow that money back to? Your private reservoir, your banking system. When that starts to happen, you're going to see this system go exponential. What we're only covering today is pure just where to save and how much of that do you want to own. Going into February, we're going to show you a couple slides from February's class. That's when we're going to show you how to start using these for your investments. Okay, so let's review this path of money real quick to orient ourselves. There's really only 4 things we can do with money. Money comes into our life that we're working for. That's your active income. And the 4 things we can do with it is spend it. Then we can donate it. The rest is called savings. So the third thing we can do with money is hold it. And the fourth thing, which is what everyone wants to focus on, is investing. Now, all of those are great, but if you get out of sequence with this, you're going to experience a lot of financial pressure in your life. And so where does life insurance exist? Biggest misconception is that it's some type of investment or acceleration vehicle. It is not. It is a liquid safe asset that you should be saving in to then go make your investments. And so it is a foundational asset, and that's why you want it. And having an account, a policy like I just showed you, that's why I own multiples of these today. So do you, David.
Yep.
One was not enough. We got our feet wet. We wet our appetite with one. And once we saw it, it was like, I need way more of this, which is very typical. It's going to happen to everyone on the call. As that money was increasing, I started Factum 7 years ago, went commission only, made the leap. And what was great about floating myself through that unpredictable income time in my life is I had a policy and policies that were constantly growing for me. So if I ever needed something, I could go to my policies because they were growing very effectively even back then. So this really helped me solve the unpredictable income problem. Also, excessive spending. Sometimes it's really important to have good guardrails in place. I remember reading The Richest Man in Babylon earlier in my life, like right before I met Diane, and I would save money in just envelopes, cash.
Mm-hmm.
The problem was it's very easy to not do that if you don't want to. You get what I'm saying?
Yeah.
And so when I had the policy, it kind of felt like, ooh, I kind of need to fund this thing. Now I look back and I'm like, I'm so glad that added an extra barrier for me. Like I kind of needed to, it was a forced savings habit that helped me reduce some excessive spending. You can look at that as a negative. I went ahead and looked at it as a positive.
Discipline.
Next thing is reliance on credit. One of the most compelling things about becoming your own banker is the bigger that policy gets. You all know how to use that loan provision. There is no credit check. They don't ask you what your taxes are or for income. They don't even ask you what the loans are for. That you fill out 2 forms. We're going to go over that next month in next month's class. and you can use that for whatever you want. So my reliance on typical credit, it gets lessened and lessened each day my cash values are increasing. I cannot wait. We're probably a few years away from getting there, but I'll never have to participate in the commercial banking system again and use their credit system because we got it privately now.
And that one is one of those where people, when you ask them, hey, where's your safety net or your rainy day fund, they rely on a credit card, they rely on a home equity line of credit. What if you could solve that with a private asset?
Love it. Lack of liquidity. I think a lot of Americans don't want to keep cash lying around because it's so efficient. But when you have it in a place like I've got it now, you know how exciting it is? I say no to way more investments now because it's so hard for investments to even beat some of my older policies that it makes no sense for me to go out and invest unless it is a smoking deal. I get so much time back. That's time you can go spend with your family, working in your business. It's a much more peaceful way to live when you can say no to a lot more things. And lastly, you can use these policies as passive income streams for the future. So another big source of Americans' financial pressure is retirement uncertainty. I don't know how I'm going to retire. Well, that's why people invest in real estate. They get self-directed IRAs. They invest in the stock market. But what they never address is how inefficient is your category 3, your hold category. If you only hold cash in savings accounts and checking accounts, that never has the capability to turn into a passive income stream for you. But that policy I just showed you, you can convert those into very aggressive passive income streams later on. So if you get to the point where like, I just want to travel now, thank goodness you were funding all that premium into those policies.
Absolutely.
Okay, let's move on, David. Let's go to stage 3. This is going to be the largest jump in the equation, and it requires the most intention. I'll just tell you, I don't think not everyone goes to this stage.
Yeah.
And when you go to this stage, you're at this point where my mindset was at a number of years ago is like, once this all started clicking, I'm like, how do I get every dollar of free cash flow I have into my banking system? You expand the system, you probably have multiple policies at this point, and now you're starting to integrate more of these key components of wealth building. You're probably getting your asset protection, your trust up and running. You've got the insurances in place. It's a part of your cash flow management system. You're investing the debt. All of those things are being incorporated here. And because of that, you're going to see the biggest jump in what this is costing to you. When you get more efficient with your taxes, your insurances, your debt, this requires a wealth team. And when you do that, you're going to see that separation from most of Americans. To go to a stage 3, it is worth every dollar that you're seeing on that screen, but it is going to require some intentional work.
Yeah, and the way we describe this mindset is start to see the entire set of policies as an enterprise or a business. You'll see people that have different habits like tracking their cash value growth and their death benefits, and they're going to plan for when premiums are paid throughout the. It's a more intentional approach. Obviously, that produces a different result. And the way we would advise you to think about this is, let's start to evaluate the bigger parts of the map. How is my relationship with the different components of wealth? So if you go to the next slide, I believe we have the example of what this would look like, right? Same family, same initial 7.5%, but now they get very intentional and they say 30% is what I want to keep, Kyle. Or that would be equivalent to the $90,000. Out of every $300,000 I make, we want to keep $90,000. You guys already know the answer. Therefore, we must manage our spending. And in here, they're going to get very intentional about eliminating low value spending, excessive tax payments, and also now they're going to finance some of these things more efficiently through the use of that flexible loan provision and life insurance policy. Some of the examples here, for example, their travel, Kyle. How can we finance that travel from our whole box, from our foundation?
Instead of using a credit card, you're going to use your own private banking system to create wonderful experiences with your family, which a lot of us on the call are currently doing that.
Yeah.
You have a wealth team, so you're probably paying less in taxes because your financial IQ is going up. And this is the right time to bring in that wealth team that will cost you to work with them, but they're going to save you way more with their professional services, right?
Yeah.
So a lot of people want to jump to that stage, David, and I think they like, for example, I need to go get my trust set up. It's like, well, depending on how many assets you have, what's going on in your financial life, that may not be the best use of your time, energy, and resources. Yeah. And so you want to do these things in the right sequence. And going to the stage 3, you're going to need a copy of our digital wealth scorecard. So this is 115 questions around the money game. We have clients that'll do this in 3 months. We'll have clients that do this in 3 years. And there's no right or wrong, but understanding what do I not know about the money game and what have I still not implemented is one of the greatest ways to get intentional to go to that next stage. And once you know where you need to focus on, now it's just a matter of working with your Factum agent, getting with our preferred network of professionals to really start chipping through a lot of these items. And as you do, you already have the disciplines and the know-how of exactly where to siphon that money. It's going to go back into your private banking system.
Yeah.
Okay. Let's go to stage 4 now. Now we're thinking big. Now this is going very high level. This is what gets me excited. This is what infinite banking, in our opinion, actually is at this point. You've got all the first 3 stages down. You've mastered those. Now we're going to jump into the infinite banker. At this stage, because influence and significance is becoming relevant to you now, you've got the disciplines. People are probably reaching out to you at this point saying, how are you doing what you're doing? I'd love to learn from you. You're probably influencing your family. They're watching you grow. And now they're saying, what are you up to? Is this thing that you were working on? That's starting to happen at this point. Multi-generational legacy, wealth preservation, those things are all happening because of the habits and the disciplines you built in the first 3 stages. And there's a huge step up here from being the business banker to the infinite banker as well. This is another giant leap. And I would say this leap is probably much, much easier than going from stage 2 to 3.
Agreed.
Going from 3 to 4, it's like you're already that person. And it's just a matter of time before you start doing all the cool, fancy stuff now. So at this stage, we got the same family saving the 5%. Now we're saying we're getting 50% of that income into whole life one way or another. And so the way that you do this is you've probably pulled in your charitable donations that you were just sending out in cash. You're doing that through your policies. You're doing travel. You're way more invested into your tax strategy. All the different things, the components, key components, you're intentional with your debt, your savings, your liquidity, all of that's happening. And this becomes an actual potential reality for you, getting 50% of your income into whole life insurance.
By the way, there's leverage here, and I think the reason it feels different and it feels easier is because now there's a team, now there's habits in place. You're tracking your net worth every month. You're tracking your expenses and P&L. There's a series of things. The key word in the book that I always point to is becoming your own banker, and banker is capitalized in red. But to me, the key word in that title of the book is becoming. And that's the pursuit here. Those stages are a progression and a function of 2 things: more education, more implementation. And with that experience, you do more education, more implementation, and the progression becomes your reality. So,
well said. So once all those disciplines are there, what are we doing now? Now we're operating family banking businesses, and this could be not only your personal family, but this could be your business family. You're affecting more lives, and so generational wealth transfer it's almost too simple at this point. So you start focusing on more advanced things like writing your legacy letter. We call that our future family letter. It's the document that my brother and I wrote for future Fuller generations, for them to understand how they have the resources that they will have when my time's up here, right? Wealth is so assured at this point. Now you focus on how do you protect it and make sure the right visions, values, and leadership principles are established as well. So if you've not seen what our family banking education looks like, you have QR codes there. You could scan those. It'll take you to videos on the family banking business and how to transfer wealth generationally speaking. And so this is what it really means, I think, to go to the infinite banking level. You got tough money habits. You're controlling as much of that money reservoir as you possibly can. And now also you're coupling all your investing strategy into this as well, which is what we're going to be teasing and showing you next month in February. So next month, our deep dive topic, we're going to be going back in time to analyze a deal that 30-year-old Kyle did. I'll be 37 next month. 30-year-old Kyle used my first life insurance policy to purchase some real estate that we held for a couple years, sold it, made $200,000, directed that back to our whole life policy. And because we did that, the impact on my wealth plan was over $2 million additional over my lifetime just by making that one investment. So we just talked to you about just controlling the banking function. Now what we're going to show you going forward, every deep dive after this for the rest of 2026 will be on the strategies to take the foundation that we just taught you and now say, how do I use it for real estate investing, hard money lending? How do the policy loan mechanics work? We're going to be going really deep on all of those topics. So this is a real case study, real property my wife and I bought, sold, directed all of it back into premium. And so the net effect of that was over $2 million over our lifetime for that one investment.
Cash value, not death benefit. One move, one policy. Keep in mind, Kyle has a portfolio of policies and a myriad of the financial decisions he's going to make now until age 90. But it is a perfect example to, again, realize a couple of things just in summary, and we'll open up for questions here, which is the following. What you do with your income matters. Managing your expenses matters significantly, so you can decide the amount of savings or the amount of money you keep. That's the first habit, and without it, nothing else moves forward, Kyle. Would you agree with that?
Absolutely. You've got to focus on the financial behaviors, the tough money habits. If you want to be successful with infinite banking, you have to get more intentional with your money management habits.
Yeah.
It's a prerequisite if you're planning on going to that level, right? Yep. So let's open it up. We'd love to know, what questions do you have for myself, David, Wade, Josh, anyone on the call today? We'd love to take a few questions. We told everyone we'd have you out before 7, so we'll stick around for several minutes. If you have questions, we'd love to know what's going on in your head. Anything not make sense, you want clarity?
And thank you for all the comments in the meantime. By the way, Wade, you had a question. You might be on mute, my friend.
Yeah, thank you, David. I think it's really important to understand too, is like what we're talking about is just this idea of savings. And it's not like most people see savings and investments as money leaves our environment, our ecosystem, and it never comes back. It's untouchable. What we're talking about here is just really the opposite of that. We do save it, but yet then we have a plan to put it to work. And we start saving it in the right environment first. That's the first step. That's the proper sequence. And then it goes back to that path of money you were showing. It's like once you have those dollars there, then it's like, okay, now what are we doing in order to accelerate those dollars? And so I think a lot of times when we show people this idea of like, what's the difference between a stage 1 and a stage 4, they kind of go, oh, but then I lose all. Am I really saving 50% of my money? Or am I really going to save 50% of the money? I can't run my business, can't operate my household on 50% of my revenue. Well, that's not the situation we're talking about. It's like once we save it, then we can put it to work.
I love it. And Wade, I saw in the chat someone asked, "Oh, what do I do in a stage 1? What's the best thing I can do?" The best thing you can do in a stage 1 is commit to saving at least 10% of your income. And I would start getting on our tough money curriculum. Get real intentional now on your debt criteria, your liquidity criteria, how much you're saving. We teach you a little bit about what's the investing criteria you should have when you're ready to do that. I would go through that tough money curriculum as fast as I could, because that's going to give you all the disciplines to be wildly successful with this in the future. Where we see people go wrong is they jump in and they try to do advanced strategies like family banking, but they don't have the financial disciplines to actually carry it forward. So it ends up creating a lot of noise and havoc in their life. And without an intentional investing strategy, you end up just losing money over time. Yeah. You're doing a lot of work, but you're just not that productive. So I would get on the tough money curriculum and commit to an early savings number and start getting that into your first whole life policy if you don't have one yet.
Yeah. And I think just to add to that real quick, it's a progression and it's making progress. That's right. It's never about perfection. It's like getting started. I think we showed a chart at one time, David, this idea of like, how do we go from stage 1 to stage 2 to stage 3? It's all about implementation and education. The more you educate yourself, the more you implement it, the more you do it. It's like, okay, I'm here. Now I'm aware that there's another stage. How do I get there? More education, more implementation. So you start moving your way up that ladder. And again, it is a progression. Rarely do we see it happen overnight.
Right. My favorite definition of financial management, and Tina, I see your hand, and we're going to you right after this, by the way. Thank you for being here. My favorite definition of financial management is the ability to make financial decisions. And I'll tell you, and most of us will relate to this, my wife and I were terrible savers, and then we developed some habits, some ideas, some tools. We became great savers. We saved 60% of our income. Then we had kids. Guess what? The kids ruined that savings rate because kids require money and things change. And we constantly use this as a way to check with each other. How are we managing our relationship with money? Because life will change. And I'm sure as we progress into other stages of life, that will be true. The key is, do I know for sure if the way I'm managing this is going to lead me to the path I want? So thank you for sharing, Wade. Tina, pleasure having you tonight.
Thank you. Hey, I'm friends with Josh Rose, so that's my
Love
connection
it.
to y'all.
It's a wonderful guy. So
Okay, so we've been discussing, we do have a policy through you, and one, I understand that it's not an investment. Like that makes sense to me. What I've tried to understand is this concept of like putting every dollar in your life through a policy. Like that's still not quite making sense to me for this reason. I understand the benefits of like, I think, I think I'm thinking like a saver, if you will. Like I understand the benefits of having the liquidity and the privacy and all of these things. But say I want to use it in more of an investment style. So like having it be your bank that you would invest from, which I think is like part of moving to the higher levels. I understand that like say I had $40,000 that I would use as a down payment or something, and then I would just use it as cash. If I used it the normal way as cash, that money would flow away from me. And I understand that one of the things you guys talk about a lot is that by doing it through your policy, that the money isn't flowing away from you. Like, I think I understand that concept. The part that I keep getting into a mental difficulty about is if I use my policy cash value to redirect that $40,000 towards the investment property or whatever. What about the second, like there's still a second $40,000 that I eventually have to pay that back to my policy, right? Otherwise, I'm going to accrue this, 2% or whatever forever, and that's not efficient. What about the opportunity cost on that second $40,000? Like, I feel like we are always focusing on the first $40,000, and we talk about the benefits of like, the first $40,000 stays in your policy and it gets the 5% or the 3% or whatever over time. And we don't really think about like, but then we still have to pay that $40,000 back with the second $40,000. And there's an opportunity cost there as well. And so that's like, I just haven't been able to like understand how that's not a problem because if that makes sense. I don't know if that makes sense, but.
thank you, Tina. I want you to respond to that. I will tell you, I love that you said all this, and I want to thank you because what we all get to witness through you and learn from you is you're working that progression of understanding and implementation from one stage to the other, and to allow us to see your thinking is really helpful for all of us. So I hope you know that we're really grateful for you to share that. What are your thoughts there?
So a couple of things, Tina. So when you are going to use your policies to invest, you got to think like a banker. Would a banker ever loan out $40,000 without some type of expectation that that money's coming back with more than 40? No way, right? You wouldn't be in business very long. So if you look at this path of money slide right here, when you invest, if that money comes from your policy here, the investment should kick off income that comes right down into your life that could go and refill that bucket over time. And so that would help you bridge that gap. I think where people go wrong with this is they take a $40,000 loan and they use it for something that's not going to create cash flow. So if you're not buying something that creates cash flow, guess who has to replace that? You do, with your income somehow. And it's why you got to have the right tough money habits. Now, to your other question about like, how do we get every dollar flowing through premium? That's page 48 of Nelson's book. Income and premiums should be equal. Okay, so let's go back up here real quick, and we'll go to these slides, the 4 stages. How I was thinking about life insurance here as the saver is very different on how I think about life insurance over a decade later now, actually doing infinite banking. So if you're in the early stages of this, I'm going to say it's impossible for you to accomplish that. Don't waste any time thinking about getting all your income into premium. You see this policy here in the year 13. If my income was $80,000, meaning my expenses have to be less than that if I'm saving anything, could I technically put $80,000 into this contract and make $160 and flow all of my income into that policy? That actually would be possible. Do you think it's even easier in year 28 of this thing? Absolutely. So if you read Nelson's book, he'll tell you most people, it'll take them 20 to 25 years to build a banking system that they can handle all the things that they would need to finance in life. Now, the question is that a strategy you should actually pursue? I don't know if it's the most efficient thing to take a policy loan to go buy groceries. Let's put it that way. But I do think having liquidity matters. And having liquidity when events happen in the big wide world allow you to go out and buy assets that should produce cash flow that can feed your policies in the future. I think that's a much better model for what we're trying to discuss here.
Yeah.
I like the idea, and I'm not saying you shouldn't do it because I've used policy loans for vacations, things like that. But guess who had to refill that loan over time? I did. With what? My income. So hopefully your income's going up if you're doing that. Otherwise, you might find yourself in a position where I just dug a bigger hole for us, right? And so it all comes down to strategy, but that's why we're saying you're going to be thinking about things differently depending on what stage you're in. So there's certain things we want you to focus on in certain stages that'll help you get to those later stages of the policy, because everything gets simplified when you got one of these suckers that's 13 years old now, right?
Can I add something really quick? And I don't want to steal your thunder. Could I borrow your 30-year example for the graph, not for the numbers? The second to last slide you showed us, because I think there's something that I use in this conversation also that is helpful with clients, and it would be this one over here. And is this, from a mechanics perspective, something that also can help you clarify this conversation with Josh over time is this. In the path of money, it looks like you're taking money out of the policy to put it in the investment. But in the reality is that money staying inside the policy never touched. And what we're doing is borrowing from the insurance company to access that liquidity, which is why we need to replace that money over time. And that separation there of where we source money to invest and where we keep money compounding starts to clarify the process of what's actually happening and why the benefits are available to compound daily, to have a flexible loan provision, to keep it private. So I think something like this might be a conversation, Josh, that I would encourage you to have with Tina. But I love that you let us see your thought process. Thank you for being here, for being so kind and generous with us.
I love it. It's a great question.
Let me see this. Sorry, go ahead.
Oh, Mr. Wade, any other questions in the chat for us?
Yeah, there was a couple here. Let me grab those real quick again.
I see one while you look, Wade. Jennifer and Demary, hi guys. Thank you for being here. We appreciate you. It says, how does a 401k play into all of this, if at all, Kyle? What do you think?
Love it. So going back to biggest misconceptions around life insurance, I'm going to go ahead and put a 401k in the investment or retirement category, right? Remember, anything in your green box where you hold and save cash has got to be liquid and it's got to be safe. Most retirement grade vehicles, 401ks, IRAs, stock market, even real estate, they're not exactly safe. They can, over a long time, they can have wonderful averages, and a lot of them are not liquid and accessible, especially if you have to prove that you need money at that time is going to be one of the most difficult times to get access to those funds. So 401k, love it. IRAs, love it. Those all exist in this gold box down here around acceleration and retirement. Your whole life policy is going to complement that by increasing the efficiency of your cash reserves and acting as a liquidity buffer against unforeseen events.
Yeah.
And so you want both is the short answer of it. Your whole life should support whatever your investments are doing. That would include a 401k.
And that second arrow that you have up here, Kyle, think about this, just Demary and Jennifer. That's in the accumulation, the liquidity. What about in distribution when we're 60 and 70? Like, could in years where the vehicle of investment 401k are not performing or negative, could we use our safety, our foundation to source our income from, to supplement and to add longevity to our overall money? By the way, number one fear in the baby boomer generation, running out of money when they're in retirement, because they're exposed to that constant volatility, the excess taxation, all that uncertainty can be tampered down with certainty by having a guaranteed asset that protects you. So thank you for that question. That's wonderful, and it's great to see you both. Any other questions, any other comments, thoughts?
I think there was
7 o'clock, so if you need to hop off, go ahead and hop off. No problem.
I was going to say, there's one from Logan that says, what are some of the best things to do if you're in the saver stage or saver step one?
10%.
Yep. I think we got to that one a little bit earlier, Wade.
Oh, dude. Okay, I'm sorry. Yeah.
Save 10% of your income minimum. Like if you just do that, you're going to beat most of your peers by default and get on our tough money curriculum. Get your policy started. Try to save 10% of your income. Commit to that. Once you got that habit down, that's when I would look at starting your policy. I probably wouldn't do it before the savings habit's in place. And then get on our tough money curriculum. Greatest thing you can do in stage one is increase your financial IQ and your financial disciplines.
Yeah, I would say it's the habits, right? We want to develop really good habits with our money. I think that's the best thing you can do as stage one to move to a stage two, and then continue to increase those habits and get better with our habits of saving and being disciplined with our dollars. Again, going back to Tina's point, if we borrow money to go buy for a down payment on a piece of property, one of the habits we have to have is like, what's our plan to repay that? And then again, because if you're a banker, there's an expectation the money has to flow back with some more friends.
Got to be a good banker.
Yeah.
So we appreciate everyone for hopping on the call. Everyone will get a copy of this recording, and we'll send out the information for February's deep dive, which is going to be using your policy to go make the investments. How does that flow of money work? How do the policy loan mechanics work? Everything in between. So we're going to show you how I did that one deal with my wife that added over $2 million to our wealth plan over the next 60 years.
Yeah. Blessings to all of you. Have a wonderful evening. We'll see you in February. Thank you so much for